Hey y'all, it's been a while since I've posted anything. Life's been hectic, but I'll save those life updates for another video. The main purpose of this video is to finally fulfill the promise I made that I'd post a full walkthrough of my favorite technical trading setup, the LFG model, which aims to profit from institutional stop-loss hunts. My 2023 Trading Insights video covered the psychological aspects of achieving consistent profitability, but didn't cover any technical concepts because I wanted to be clear that if you don't have the right trading mindset, you won't succeed with any technical setup, no matter how promising it sounds. If you're currently struggling to be consistently profitable, I'd highly recommend you watch my 2023 Trading Insights video first if you haven't already. That being said, I've been forward testing this particular technical setup for over a year now, with great results, and I'm super excited to finally share the JoshTrades LFG model with the world. The LFG model stands for liquidity for grabs, but it can also stand for let's f***ing go because of how well it works. This model essentially sets high probability retracement entries inside liquidity pools, which are areas that tend to have many stop loss orders. These liquidity pools are used by institutional traders to fill their large entry orders that usually can't get filled all at once. So this model's goal is to follow the institutional traders in grabbing some of this liquidity and catching a piece of the larger trend that's fueled by these massive orders. One of David Paul's most famous quotes is to set your entry orders where retail traders are most likely to set their stop loss orders.
The third rule is that I want to put my entries where the masses put their stops. Most people will put their stops at very predictable places. If you're an institutional trader, your job is to generate the liquidity to get into the position. They know that most people will put their stop a tick or two below the last low. And invariably, the market will go to where the obvious stops are over and over and over again.
The LFG entry model does precisely that. It lets you trade with the big institutional traders, not against them. The win rate of the setup depends on how you manage the trade, which can be very subjective, but from my experience using a very basic set and forget target of 1R, which I'll explain in detail later in this video, the win rate is approximately 60% as a baseline, which is absolutely long-term profitable. I wanted to highlight this baseline win rate now, so if you don't think it's high enough for your liking, you can stop watching. But I also hope you realize that any technical setup targeting 1R or more that claims to be more profitable than this in the long term is most likely a scam. Backtesting results are unreliable because backtesting is literally the definition of hindsight bias, so don't believe the obscure strategies with random indicators using random values that show super high backtesting win rates. My LFG strategy is based on universal price action concepts, market psychology, and uses a small amount of discretion that can't be captured in any backtesting simulator. Anyway, sorry for that rant. If you're still watching, I appreciate you. A lot of time and energy went into creating this tutorial, and I'm sharing all of this completely for free because I truly want to help all of y'all in your own trading journeys. I sincerely hope that y'all find success using this model, and even if you don't end up using it, you can at least incorporate some elements into your own trading strategies. If you get any value at all from watching this video, please consider buying me a coffee using the link in the description. Sorry for another slight tangent there. Let's get into the details of the setup. The beauty of the LFG model is how simple it is, and the setup can actually be broken down into only 3 steps. The first step is to identify the current trend and wait for a retracement. A trend is bullish when price is making higher highs and higher lows. A trend is bearish when price is making lower highs and lower lows. There's some nuance to identifying trends that I might discuss in detail in a future video, but I'll keep it simple for now to get through these steps. Now, trends don't last forever. Eventually, there will be a meaningful attempt to reverse the trend. In a bullish trend, price will eventually start making lower highs and lower lows at some point. This is the retracement we're looking for before moving on to the next step, which is to draw your Fibonacci levels to capture the entire range of the identified trend. For bullish trends, you want to draw your fibs from the most recent low that took place before the higher high to the highest high before the retracement. For bearish trends, you want to draw your fibs from the most recent high that took place before the lower low to the lowest low before the retracement. The only Fibonacci levels you need are the 50% and 79% levels, which form the boundaries of a key zone where I found most reversal attempts will fail. This is the LFG retracement zone. The third and final step is to identify the liquidity pools, which are generally right outside the minor highs and lows that exist within the range you drew your fibs on. Smaller timeframe traders generally set their stop loss orders below a minor low or above a minor high, making these areas especially likely for institutions to set their entry orders. So this is where we want to set our entry orders. More specifically, you want to set your entry order within the liquidity pool that's inside the LFG retracement zone. The closer it is to the 50% level, the higher likelihood of getting your entry order filled. For a long entry, I generally set my limit order one tick above the pivot low to ensure that I get filled, just in case it's a perfect double bottom and not a liquidity grab below the lows. That's pretty much all there is to the entry model. As you can see, the entry rules are objective and simple, but how profitable it will be depends on how you choose to manage your trade and where you set your profit targets and stop losses. Later in this video, I'll show a few different examples of trade management in live trades. As mentioned earlier, trade management is really based on personal preference. Some traders like to actively manage their trades and are constantly adjusting stop losses and profit targets, while other traders prefer a more set and forget strategy. How much profit you're targeting relative to your risk also has a huge impact on your win rate. For example, targeting 4R will have a much lower win rate than targeting 1R. Then you can also add to your starting position and have various take profit levels and leave runners. There are really an infinite amount of ways you can manage a trade after you enter, but I recommend starting with this very specific baseline strategy just to get a good feel of how the setup works. To keep things simple, there will be no scaling into or out of your initial position. Once you enter, your stop loss and take profit orders will exit your entire position. Your stop loss should be set at one tick outside the entire range that you use to draw your Fibonacci retracement levels. For long entries, it would be one tick below the lowest low of the range, and for short entries, it would be one tick above the highest high of the range. The main reason for setting a stop loss here is because price hitting this level would mean that the trend we're trying to capitalize on with our retracement entry has ended, and the market structure has either turned into a trading range or a trend reversal. Our trade thesis is clearly no longer valid, and we don't want to be waiting and hoping for things to turn around back in our favor. Al Brooks teaches in his trading course that once a trend is established, attempts to reverse the trend are more likely than not to fail.
Trends usually don't just reverse abruptly. They usually enter a trading range first, which means that there'll be a pullback and then the market will test the old high. Sometimes I'll even buy more on the pullbacks.
If you believe this to be true, our stop losses that are outside the range of the primary trend are less likely to get hit than our profit targets. Which brings us to the question of where should we take profit? So once you set your stop loss order, set your profit target to where your total profit is exactly what your total risk is. Or in other words, this basic setup has a simple 1-to-1 reward to risk ratio. The deeper your retracement entry, the tighter your stop loss will be, and also the closer your profit target will be. Since your LFG entries will always be within the 50% and 79% Fibonacci levels, your profit targets will always be somewhere within the identified range, and won't even require trend continuation to hit your profit targets. Even if price just starts to chop around within the range, there's still a good chance you'll get your profit target, which is why I recommend not adjusting your initial stop loss or profit target after entry when you're first trying out the setup. I'd say that the win rate of this basic 1R setup is about 55% over the long term if you follow these rules exactly without any other confluences. The extra 5% to bring the long-term win rate to the 60% that I mentioned earlier is getting an extra confirmation from the accumulation distribution indicator, which is my favorite indicator for determining bias. I won't go into details on how AD works in this video, but if you want to learn how to use it, please check out my tutorial linked in the video card. To use it in confluence with the LFG setup, you would only take a long entry if AD is not clearly bearish, and you would only take a short LFG entry if AD is not clearly bullish. If AD is neutral or unclear, you can go ahead and take the entry. Yes, I understand that this AD confluence requirement is a bit subjective, and it may take some practice to read AD correctly, but some subjectivity and experience is absolutely necessary to become a profitable trader. So that just about covers the very basic version of my LFG setup that uses a simple set and forget 1R trade management strategy using accumulation distribution for extra confluence. As you get more comfortable with trading the LFG model, you should absolutely make adjustments to how you manage your trades according to your personal preferences. Use your own experience and intuition to decide when to scale in and out, when to trail your stop loss, when to go for more aggressive targets, or when to not take the trade even when all the requirements are met. Maybe you don't like accumulation distribution or have your own preferred indicators to use for extra confluence for your entries. These are all ways you can increase profitability above the 60% 1R baseline when trading this model. In other words, feel free to put your own spin on this model and adapt its basic concepts to your own unique trading style. Now, before we get into some real examples of how I trade the LFG model, please like and subscribe if this model has piqued your interest at all, so you're notified of any future videos covering more advanced topics relating to the LFG model. So now I'll be showing some few different examples of the LFG model in action, starting with the basic 1R setup I just described. Here we have a very clear uptrend where price made new highs. On the 2-minute chart, it looks like just one leg up, but on the 1-minute or under chart, you would see higher highs and higher lows on this run up. I drew my fibs from the lowest low to the highest high of this particular range and identified a liquidity pool right around the 50% fib level of this range, which is the edge of the LFG retracement zone, so it's a valid entry. I also had AD confirmation where AD was also making higher highs and higher lows, confirming the bull trend. Right after our long entry, we see liquidity get grabbed, indicated by an immediate pump after those minor lows got swept, which is usually a very good sign for our trade. We set our stop loss right outside the bottom of the range, which makes our 1R profit target at the top of the range, since our entry was right in the middle of the range. You'll see that after price makes a new minor high, I moved my stop loss under the low of the liquidity grab, because if price were to retest this level, it would be a clear sign the bull trend was weakening, and I wouldn't want to be in the trade anymore. I know this isn't exactly the set and forget strategy I discussed, but it didn't even matter where the stop loss was set, because my 1R profit target at the top of the range was very quickly hit, which makes this a very ideal example of the LFG model playing out perfectly. Of course, not all LFG trades play out this way. Here's one where the complete opposite happened. Price had been dumping all morning, and I was waiting for an opportunity to short to follow the higher timeframe trend. I get a chance when price retraces a little before resuming the bearish trend, making lower highs and lower lows again. AD confirmed the bearish trend as it was also making lower lows and lower highs. I drew my fibs from the top of the range to the bottom and took a short entry at a liquidity pool within the LFG retracement zone. After an initial rejection that looked promising, bulls took control and pushed price upwards to hit my stop loss. I included this example to show that you will absolutely take losses with this model. In fact, 40% of your trades with the basic 1R setup will be losses over the long run, so you can't let a few losses in a row discourage you. You have to trust in the long-term edge of the underlying price action concepts and accumulation distribution data to find success with this model. Now I want to show an example of a slightly more advanced modification of the basic 1R setup, which is pretty close to how I'm currently trading the LFG model now. Price was pretty choppy all day, which I found is actually pretty good for the LFG model. I identified a bull trend where price was making higher highs and higher lows, confirmed it with AD, and set my entry orders at liquidity pools within the LFG retracement zone. I'm buying 2 contracts here, and when I get filled, I set 2 profit targets, both at opposite liquidity pools, with one being more aggressive. I go into a bit of drawdown, but patiently wait for price to find support, trusting that attempts to reverse the bull trend are more likely to fail, and my stop loss set below the bottom of the bull trend range is more likely than not to be safe. Sure enough, after a bit of drawdown, bulls step back in and push price back above my entry. Once this happens, I adjust my stop loss to be 1 tick below the most recent low before the bullish momentum resumed, and adjusted my profit targets, putting the more conservative one at 1R, based on where my new stop loss was, and put my run-at target at the nearest opposite liquidity pool. Both targets are easily hit, and this is just an example of another way you can trade the LFG model with active management to mitigate your risk and go for multiple profit targets based on your personal trading preferences. Lastly, I want to show another more aggressive variation of the LFG model where you set your entry at the exact 50% fib level of the range instead. With this setup, you're essentially betting that once a clear trend is established and you have AD confluence, if price retraces down past the 50% level, it is more likely to resume the established trend than fully reverse the trend. The main difference between this and the main LFG model is you're not entering at liquidity pools, but rather the simple 50% retracement level of the range, which I found to be a very significant level that tends to have large institutional orders. This setup has a slightly lower win rate over the long term, but you can take it over and over again due to how often this setup presents itself because of not needing liquidity pools for entries. Anyway, in this example, I sit through a bit of drawdown again, but sure enough, bulls step in before my stop loss gets hit, and pushes price back above my entry. So once again, I move my stop loss under this higher low, as I've now identified this to be a level where if price were to retest this, I would not want to be long anymore. I move my profit target to be 1R relative to this new stop loss, and let the trade fully play out for a nice win. So there you have it, a complete tutorial of my LFG model, a basic 1R setup you can start with, and some other examples of how you can manage LFG trades. As I mentioned, once you get comfortable with taking the basic setup, you can improve your profitability by managing your trades based on your own preferences and adding your own preferred confluences. I personally like trading the setup on the 2-minute chart for intraday entries and exits, but since price action is fractal, the LFG model will work on any time frame. Just know that as you increase the time frame, the less frequent the setup presents itself, and fewer entry opportunities you'll have. I hope y'all will like this entry model as much as I do, and please leave feedback in the comments if you end up trying it out. Feel free to also post any questions as well. Alright, this video is now insanely long, but there really was just so much to cover, and I didn't even get to touch on some of the nuances of the setup. I'll be discussing those in future videos, so please like and subscribe so you're notified when I post them. Again, if you found this video helpful at all, and maybe even made some money using these concepts, please consider supporting the channel by visiting the Buy Me a Coffee link in the description. Other ways to support the channel are to use code JoshTrades for the best available discounts at Apex, Trade Day, and FunderPro, which are all prop firms that I'm currently affiliated with. My next video will discuss why I started trading with FunderPro and why you should too. Until then, happy trading everyone. Let's f***ing go.